Welcome to the deep dive. Today, we're going straight into the core of blockchain technology.
Yeah, the foundations.
Exactly. And look, for many investors, maybe even for you listening, the headlines around crypto scams and, well, the lack of clear regulation,
Mm,
it creates a lot of hesitation.
understandably so. There's definitely noise out there.
We get it. So this deep dive is specifically for you. We want to unpack the actual foundational technology, the stuff that's designed to build trust and security right from the ground up.
Precisely. Because beneath that sometimes, let's say, chaotic surface of the crypto world, there's actually a fascinating and quite meticulously engineered system.
So our mission today.
Our mission is really to extract the essential principles. How do networks like Bitcoin actually work?
Yeah.
How does the technology itself aim to provide that security and verifiability that people are looking for?
And to guide us, we're using some really solid material, specifically a chapter called Crypto Economics and Bitcoin's Foundation from the book Token Economy.
It's a great source for understanding the cryptographic and economic DNA, so to
Yeah.
speak.
Think of this as your way to really grasp what makes blockchain tick, especially if you're feeling wary.
And what's really key, maybe the most groundbreaking part, is that blockchain security doesn't hinge on a central authority. No big bank or government acting as a gatekeeper.
Right. So where does the trust come from?
It actually emerges from this clever interplay of cryptographic tools, math, basically, and some well-thought-out economic incentives.
Okay, let's get into cryptography then. It sounds super technical, maybe intimidating.
It can sound that way, but at its heart, it's actually quite simple. It's about secure communication, secure collaboration, especially when you think there might be, eavesdroppers or people trying to manipulate things.
Keeping information safe and tamper-proof. That's the goal.
That's exactly it. And this desire is ancient, right? Keeping secrets. But the digital age, well, it changed the game. It amplified the risks, but it also enabled these incredibly sophisticated solutions we have now.
So we went from simple letter scrambling.
Yeah, early analog ciphers, just, mixed up plain text into ciphertext. But then computers arrived, and they brought immense processing power.
Which could crack those simpler codes.
Exactly. But on the flip side, computers also paved the way for the really robust cryptographic systems we rely on today, for everything.
It sounds like a constant arms race, almost. Stronger defenses pop up in response to new ways to attack.
That's a really crucial insight.
Yeah.
Security in this context, it isn't absolute. It's always relative. Relative to the computational power and time an attacker would actually need.
So it's about making it impractical to break.
Precisely. We talk about computational hardness assumptions.
Yeah.
It's basically the idea that breaking these systems would require resources, time, computing power, money that are just practically impossible to gather right now.
Right.
And of course, as technology advances, the algorithms themselves have to evolve too. It's an ongoing process.
It's kind of amazing how much of our daily lives rely on this stuff without us even realizing it.
Oh, absolutely.
Online banking, shopping online, even just verifying who we are online.
Yep. E-commerce, identity verification, digital signatures. It all relies on these cryptographic tools, securing everything from simple text messages right up to massive financial transactions.
Digital signatures, you mentioned. How do they work?
They use cryptography to basically guarantee that an electronic document is authentic, it came from who it says it came from, and that its contents haven't been messed with. Integrity.
Okay, that makes sense. Now let's pivot to Bitcoin specifically. It's easy to think it just appeared suddenly in 2008.
Right, like it came out of nowhere.
But our source really emphasizes that it's built on, well, decades of groundwork in different tech fields.
That's so important to understand. Bitcoin didn't just materialize. It's really the culmination of a long history of innovation. You've got cryptography, peer-to-peer networking, and lots of earlier attempts at digital cash.
Like who? What were the stepping stones?
Well, think back to the early 1970s. You have Ralph Merkle. His work on hash functions, making them collision-resistant, and Merkle trees gave us a way to securely verify data. That's absolutely foundational for blockchain's integrity.
Merkle trees. We'll circle back to those. What else?
Then, mid-70s, you get the development of public key exchange mechanisms. That set the stage for digital signatures. Then the RSA algorithm in 78, a cornerstone of Bitcoin's whole public key setup.
These sound like critical pieces of the puzzle falling into place.
Absolutely foundational.
Yeah.
And it didn't stop there. 1991, the concept of cryptographically secured chains of timestamps.
Yeah.
Another vital ingredient for the blockchain idea.
Okay.
Then you have figures like David Chaum. His eCash in the early 80s was this fascinating early attempt at private digital money.
I think I've heard of eCash. It sounds like it was maybe too early, had some
It
issues.
really was ahead of its time. It faced big challenges like preventing something called Sybil attacks, where one person creates loads of fake identities to gain influence.
Oh.
And it had some centralization aspects too. Ultimately, regulatory uncertainty and just, well, the internet wasn't quite ready for it yet, it shut down. But it pioneered really important ideas like privacy-preserving digital signatures.
So valuable lessons learned even if it didn't succeed.
Definitely. Then, fast forward to 97, Adam Back creates Hashcash. This was a proof-of-work system designed to combat email spam and denial-of-service attacks.
Proof of work. That sounds familiar. That's the core of Bitcoin mining, isn't it? This idea of requiring computational effort.
Bingo. Hashcash's concept of making users do a little bit of computational work as a barrier against abuse was a key insight. It directly influenced later systems, including Bitcoin.
Interesting. Who else was working on this?
Well, in 98, Wei Dai proposed B-Money, an anonymous distributed electronic cash system using proof of work. It was never actually deployed, but the ideas were influential. And around the same time, Nick Sidebo was designing something called Big Gold, another decentralized digital currency idea. It even included concepts similar to smart contracts and also used proof of work. But it struggled with a double spending problem.
Ah, the double spending problem. That seems like the major hurdle. How do you stop someone from spending the same digital coin twice if there's no central bank watching?
That was the million-dollar question, or maybe the billion-dollar question. Lots of brilliant people were tackling different pieces, but that crucial element preventing double spends in a purely decentralized way was still missing.
And what about the networks themselves?
Right, in parallel, peer-to-peer networking was taking off. You had Napster, Nutella, BitTorrent, showing you could share information without central servers. But they had their own challenge.
What was that?
Incentives. The free rider problem. How do you motivate people to contribute resources like bandwidth or storage to the network when they could just take...
Yeah, makes sense.
Hal Finney's work on reusable proof of work around 2004 was an early hint. It suggested maybe you could tie some kind of value to contributing computational work to the network.
Okay, so all these different threads. Cryptography, digital cash attempts, P2P networks, proof of work ideas, incentive problems.
Exactly. And then comes the Bitcoin white paper in 2008 by the pseudonymous Satoshi Nakamoto.
This was the breakthrough, putting it all together.
Absolutely. Satoshi's genius wasn't necessarily inventing entirely new cryptographic primitives, but in combining these existing technologies in a really novel way, a way that finally solved the double spending problem in a decentralized peer-to-peer network that was also resistant to those Sybil attacks.
How? What was the magic combination?
The white paper brilliantly fused cryptographic hashing, that public-private key infrastructure we mentioned, Adam Back's Hashcash concept as an anti-spam and consensus mechanism, a new data structure, the chain of timestamp blocks, the blockchain itself, and crucially, network incentives through block rewards for the miners.
Wow. Okay, that sets the stage perfectly. Let's break down some of those core cryptographic building blocks you mentioned. First up, hash functions. We hear hash all the time. What exactly is it?
Okay, think of a hash function as creating a unique digital fingerprint, or maybe a summary, for any piece of data. It's a mathematical process.
Okay.
You feed it any input text, a file, literally anything digital, and it spits out a fixed size string of characters that looks totally random, like gibberish.
Fixed size regardless of the input size.
Exactly. Whether it's one word or the entire text of a book, the output hash will be the same length, say 64 characters for SHA-256X, which Bitcoin uses.
And the critical thing for security.
It's strictly a one-way street. It's super easy for a computer to generate the hash from the original data, but it's practically impossible to go backwards to figure out the original data just by looking at the hash.
So it's not like encryption where you have a key to unlock it.
Nope, not at all. Once it's hashed, you can't reverse it. Think of it like putting something through a very effective digital shredder. You can't tape the pieces back together to get the original.
Got it. And you mentioned they're sensitive to changes.
Incredibly sensitive. Even changing a single comma, a single letter in the input data will result in a completely different hash output. Our source uses the example how to buy Bitcoin versus how to buy Bitcoin, remove the question mark. And the resulting hash is totally unrecognizable from the first one.
Wow, that really highlights how they work as an integrity check. Any tampering becomes instantly obvious.
Precisely. That's one of their main uses.
So where do we see these digital fingerprints being used inside a blockchain like Bitcoin?
Oh, they're everywhere. Absolutely fundamental. They're used indirectly in creating your account address. They're used behind the scenes in password management systems. They're crucial for digital signatures to verify transactions haven't been altered. And critically, they're used to link the blocks of transactions together. Each block contains the hash of the previous block, forming that chronological chain. Tamper with one block, and its hash changes, breaking the link.
That's the chain part of blockchain.
Exactly. Plus, they are absolutely central to the proof-of-work consensus that whole puzzle miners are solving. It's basically trying to find a specific kind of hash. And they also enable really efficient data verification using things called Merkle trees.
Okay, Merkle trees. You mentioned Ralph Merkle earlier. What's the deal with these trees?
Right. So imagine you have all the individual transactions within a single block. You take the hash of each transaction.
Okay, a fingerprint for each transaction.
Yep. Then you pair them up, and you hash each pair together. Then you hash the results of those pairs together. You keep repeating this process, hashing pairs of hashes, moving up layer by layer.
Like a tournament bracket, almost.
That's a great analogy.
Yeah.
You keep going until you end up with just one single hash at the very top. That final top-level hash is called the Merkle root.
What does that Merkle root represent?
It acts as a very compact, very efficient summary or fingerprint of all the transaction data in that entire block.
Ah, so you don't need to check every single transaction individually.
Not to verify the block's overall integrity, because if someone tried to tamper with even one tiny detail in a single transaction way down at the bottom,
The hash of that transaction would change.
which would change the hash of the pair above it, and so on, all the way up the tree, the final Merkle root would be completely different.
Clever. So it's a powerful way to detect tampering within a block.
Extremely powerful. And this Merkle root is actually included in the header of the block, the part that gets hashed to link blocks together. So it lets every node on the network quickly verify the integrity of all the transactions inside that block without needing to download and check every single one immediately.
That sounds much more efficient, especially for, say, mobile wallets.
Exactly. It's crucial for what we call light clients. These are wallets, often on phones, that don't store the entire massive blockchain history. They can still verify if a specific transaction they care about was included in a block just by requesting and checking a small part of the Merkle tree, called a Merkle proof.
Makes sense. And our source mentioned other blockchains might use variations.
They do. Ethereum, for example, uses a more complex version called a Merkle Patricia trie because it needs to handle not just transactions but also the changing state of smart contracts. And some newer blockchains are exploring different data structures altogether, like DAGs directed at cyclic graphs, trying to achieve different trade-offs between speed, security, and scalability.
Fascinating. Okay, next building block. Public key infrastructure, or PKI. Why do we need this in a decentralized system? What problem does it solve?
Well, in any system dealing with value or identity, you need a secure way to know who owns what or who is who. In traditional systems, you rely on central authorities, banks, governments, certificate issuers to manage identities and accounts.
Right, like needing ID to open a bank account.
Exactly. But in a decentralized system like Bitcoin, there is no central authority. So PKI provides the mechanism to establish digital identities and manage token ownership securely without that central middleman.
Then the core technology here is asymmetric encryption.
That's the key. Asymmetric means two keys, not one like traditional symmetric encryption where the same key locks and unlocks.
Okay, two keys. How does that work?
Each user generates a pair of keys that are mathematically linked. One is the public key, the other is the private key.
Public and private, what's the difference?
Think of your public key like your bank account number or your email address. You can share it freely with anyone. People use your public key to send you crypto or to verify your digital signature.
Okay, so public is shareable.
Yes. The private key, however, is the secret. It's like the password to your account or the physical key to your safe. You absolutely must keep it private. Only the private key can authorize spending the crypto associated with the corresponding public key.
So how does this help with transactions? Does it solve the key exchange problem?
It does, beautifully. In the old days of symmetric encryption, you had the problem of how to securely share the secret key with the person you wanted to communicate with. Asymmetric encryption avoids that. You can broadcast your public key everywhere. Someone can use it to encrypt a message only your private key can decrypt, or, more commonly in blockchain, they use it to verify a signature you made with your private key.
The digital signatures again?
Exactly. When you want to send a transaction, you sign it using your private key. This creates a unique digital code linked to that specific transaction and your key. Anyone else can then use your freely available public key to verify that the signature is valid, that it must have been created by the holder of the corresponding private key, and that the transaction details haven't been changed since it was signed.
So it proves authenticity and integrity.
Precisely.
And our source mentioned centralized PKI versus decentralized PKI. Bitcoin's is decentralized.
Right. Centralized PKI relies on trusted third parties, called certificate authorities, CAs, to issue and vouch for digital certificates, linking public keys to real-world identities. Think secure websites with HTTPS. Blockchain offers a decentralized PKI. There's no central CA. Instead, the network itself, through its consensus rules, collectively validates the transactions signed by private keys, effectively confirming ownership without a middleman.
So the trust is in the protocol and the network, not a company.
Exactly. This leads us to the concept of decentralized accounts. Your account on a blockchain isn't held by a bank. It's defined and secured purely by your cryptographic key pair.
So what are the essential parts of a typical blockchain account then? Let's list them out.
Okay, you've got the blockchain address. This is derived from your public key, often with some extra formatting. It's what you shared to receive funds, like your account number.
Got it. Address.
Then, the crucial one, the private key. This is the secret cryptographic key that gives you control, allows you to spend or move your assets. It's like your super secure password.
Private key. Keep it secret.
Absolutely. Then there's the digital signature. This is created using your private key whenever you initiate a transaction. It's the proof of authorization.
Signature.
The public key, derived from the private key, used by others to verify your digital signature, and also used to generate your address.
Public key. For verification.
And finally, often overlooked but vital, the seed phrase, or recovery phrase. This is usually a list of 12 or 24 simple words. It's a human-readable backup that can be used to regenerate your private key if you lose your device or wallet access.
Seed phrase, the ultimate backup.
You got it. Lose your seed phrase. And you likely lose access to your funds forever if you also lose your primary device key.
And we mentioned earlier, different blockchains handle the account part differently. Bitcoin versus Ethereum.
Right. Bitcoin uses the UTXO model unspent transaction output. Think of your balance not as a single number, but as a collection of leftover change from previous transactions you've received, like having various coins and notes in your physical wallet.
Okay, like digital cash chunks.
Sort of. Ethereum, on the other hand, uses an account-based model. It's more like a traditional bank account, where your address has a specific balance associated with it, and transactions directly increase or decrease that balance. Interesting distinction. Okay, so we have these keys. How are they actually made? Where do they come from? Does the user create them?
Good question. The user doesn't typically create them directly, like choosing a password. The wallet software does it for you, automatically and behind the scenes, when you set up a new wallet.
So the app on my phone or computer just generates them.
Exactly. It uses cryptographic algorithms designed specifically for key generation, following the rules of whatever blockchain you're using. The absolute top priority in this generation process is randomness.
Randomness. Why is that so important?
Because the private key is essentially just a very, very large random number, usually 256 bits long. If the generation process wasn't truly random, if there was some predictability, someone might be able to guess or figure out private keys. So strong randomness is critical for security.
Okay, a huge random number is the private key. And the seed phrase.
The seed phrase is generated first, usually from a source of randomness on your device. Then there's a standard mathematical process, defined by standards like BIP 39, to deterministically derive the actual private key from that seed phrase. That's why the seed phrase is the master backup. It can recreate the private key.
Got it. Seed phrase, private key, and the public key.
The public key is then mathematically derived from the private key using a specific type of one-way function called elliptic curve cryptography in Bitcoin's case. Again, easy to go from private to public, impossible to go from public back to private.
Layers of one-way protection.
Precisely. And then finally, the blockchain address you share is typically derived from the public key, often by hashing it one or more times and adding some formatting or checksums.
So private key to public key address.
You've got the flow. And as we said, signing uses the private key, verification uses the public key.
And the absolute critical takeaway for anyone listening, especially investors.
Guard that seed phrase like it's, well, digitally gold. Write it down, store it securely offline, don't ever put it online or share it. It is the keys to your kingdom.
Right. And the overall security of this whole public key system relies on.
It relies on those computational hardness assumptions we talked about.
Yeah.
Specifically, the assumption that certain mathematical problems, like factoring large numbers or solving the elliptic curve discrete logarithm problem are incredibly difficult for even the most powerful computers to solve. That's why the keys need to be large and truly random.
And using well-tested algorithms is vital too, right? You mentioned a cautionary tale.
Yes, the source mentions the IOTA curl vulnerability. IoT early on tried using a novel hash function they developed in-house called curl. Unfortunately, researchers found significant cryptographic weaknesses in it, which could potentially have compromised user funds. It highlights the risk of using non-standard or insufficiently vetted cryptography. Stick to algorithms that have withstood years of public scrutiny.
Good advice. Okay, we understand accounts and keys. How do we actually use them? That brings us to wallets.
Exactly. Wallets are basically the user interface. They're the software or hardware that lets you interact with your blockchain accounts.
So the wallet doesn't actually hold the crypto.
Correct. Your crypto assets, your tokens or coins, always exist on the blockchain ledger itself. The wallet simply holds and manages your private keys and uses them to construct and sign transactions when you want to send funds or interact with applications.
Makes sense. And you hear about different kinds of wallets, user-controlled versus hosted. What's the difference for an investor?
This is a crucial distinction. It boils down to who controls the private keys. With a user-controlled wallet, also called non-custodial, you generate and hold the private keys in the seed phrase.
So full control.
Full control, full sovereignty over your assets. It aligns with the whole decentralization ethos. But, and it's a big but, it also means you bear 100% of the responsibility for security. Lose your keys, lose your seed phrase, and your funds are gone. No one can help you recover them.
Okay, high control, high responsibility. What about the other type?
Hosted wallets or custodial wallets are typically what you use when you leave your crypto on an exchange like Coinbase or Binance or use certain other services. In this case, the company manages the private keys for you.
Ah, so they hold the keys.
Yes. The main benefit is convenience. You don't have to worry about seed phrases, usually just login and password, maybe 2FA. But the trade-off is trust and control. You're trusting that third party to secure your assets properly.
And there are risks there.
Definitely. The exchange could get hacked. They could freeze your account for regulatory reasons. They could go bankrupt. You're dependent on them. It's often summed up as, not your keys, not your coins.
That's a common phrase in the space.
It is. Now, our source also notes the lines are blurring a bit.
How so?
We're seeing newer technologies emerge. Things like multi-signature wallets, where maybe multiple keys held by different people or devices are needed to approve a transaction, adding security. Social recovery is another idea, sometimes used in custodial settings where trusted friends or services can help you regain access. And things like account abstraction, especially on Ethereum, are aiming to make wallets, even user-controlled ones, much more flexible and user-friendly, potentially combining security with better usability.
Lots of innovation happening there. Okay, let's put it all together. Walk us through a standard transaction on, say, the Bitcoin network. Alice wants to send Bitcoin to Bob. What happens step by step?
Okay, step 1. Alice opens her wallet. She decides to send, let's say, 0.1 Bitcoin to Bob's address. Her wallet software crafts a transaction message. This message basically says, take these specific unspent outputs, UTXOs, that belong to Alice, worth at least 0.1 BTC, and create a new output assigned to Bob's address for 0.1 BTC. There might also be a change output going back to Alice if the UTXOs used were worth more than 0.1 BTC plus the transaction fee.
Right, specifying the inputs and outputs, then the critical part.
Then Alice's wallet uses her private key to create a digital signature for this specific transaction message. This proves she authorized it. The wallet also timestamps it.
Signed and sealed. What next?
Step 3. The signed transaction is broadcast out onto the Bitcoin peer-to-peer network. It gets sent to the nodes Alice's wallet is connected to, and they relay it to other nodes they're connected to. It propagates across the network.
Okay, it spreads through the network. Do nodes check it?
Absolutely. Step 4. Nodes receiving the transaction independently validate it. They check the digital signature using Alice's public key, which they can derive or know. They check if the UTXOs Alice is trying to spend actually exist and haven't already been spent. They check if the transaction follows all the other consensus rules of the network.
So, lots of checks. What if it passes?
If it passes validation, the transaction enters the memory pool. This is like a waiting room for valid, but not yet confirmed, transactions held by each node.
Waiting for what?
Waiting to be picked up by a miner and included in a block. This brings us to consensus and block creation. Miners select transactions from their mempool, usually prioritizing those offering higher fees.
The fees incentivize them.
Exactly. They bundle these selected transactions together, add some other important data like the hash of the previous block and a timestamp, and then they start working on the proof-of-work puzzle.
A computational race we
That's
mentioned.
right. They're trying to find a specific number, called a nonce, that when combined with all the other block data and hashed, produces a resulting hash that meets a certain difficulty target, usually meaning it has to start with a specific number of zeros.
So they're just guessing nonces and hashing over and over?
Pretty much. It's brute force guessing, requiring massive amounts of computational power across the mining network. The first miner to find a valid nonce hash wins the right to add their block to the blockchain.
And they get the reward.
They get the block reward,
Yeah.
currently newly minted Bitcoin, plus all the transaction fees from the transactions included in their block. That's the incentive.
Okay, a block is created. Is that it?
Not quite. Step 8, the miner who found the block broadcasts it to the network. Step 9, other nodes receive this new block. And they validate it. They check the proof-of-work solution. Is the hash correct? They verify every single transaction inside the block again, and they check it correctly links to the previous block.
So more verification.
Yes. If the block is valid according to the consensus rules, the nodes add it to their own copy of the blockchain ledger. Alice's transaction is now considered confirmed, usually after a few more blocks are added on top for extra security.
And that leads to finality, immutability.
Essentially, yes.
Yeah.
The more blocks that are built on top of the block containing Alice's transaction, the harder and more computationally expensive it becomes to try and go back and change it. Reversing it would require remining that block and all subsequent blocks faster than the rest of the network, which quickly becomes practically impossible. That's where the security and perceived immutability come from.
That proof of work sounds intense. Why that specific mechanism?
The key is that it makes participation costly. Miners have to invest in specialized hardware, ASICs, and spend significant amounts on electricity. This high cost makes it economically irrational for a miner to try and cheat the system. If they create an invalid block, the rest of the network will reject it, and they won't get the reward, wasting all that energy and effort. Honesty is the most profitable strategy.
So the cost enforces good behavior. And the 10-minute block time.
That's a deliberate design choice in Bitcoin. It's seen as a balance. Fast enough for transactions to confirm relatively quickly, but slow enough to allow new blocks to propagate across the entire global network reliably, reducing the chances of accidental forks or inconsistencies in the chain.
And the network adjusts to keep that time.
Yes, about every 2 weeks, or 2016 blocks, the Bitcoin protocol automatically adjusts the difficulty of that proof-of-work puzzle. If blocks have been coming too fast, meaning more hashing power join the network, the difficulty increases. If they've been too slow, it decreases. This aims to keep the average block time hovering around that 10-minute mark.
Fascinating self-regulation. Okay, final big concern for investors. Network security, especially this idea of a 51% attack. What is it and how bad could it be?
Right, so a proof-of-work network like Bitcoin is generally considered secure as long as the majority, more than 50% of the mining power, hash rate, is controlled by honest participants who follow the rules.
So a 51% attack is when?
It's the scenario where a single entity, or a coordinated group, manages to gain control of more than 50% of the total network hash rate.
And if they achieve that, what could they actually do? Could they just rewrite history and steal everyone's coins?
Okay, this is where the nuance is important. It's a serious theoretical threat, but its capabilities are often misunderstood. An attacker with 51% control could potentially do a few damaging things. They could prevent specific new transactions from getting confirmed, effectively censoring users.
Okay, censorship.
They could potentially reverse their own recent transactions. This is the classic double spend scenario associated with 51% attacks. They send coins to someone, wait for confirmation, then use their majority power to create an alternate chain where that transaction never happened, allowing them to spend the same coins again.
So they could cheat someone they just transacted with.
Yes, but primarily focusing on reversing their own recent spending. They could also potentially try to change the protocol rules going forward if they maintain that dominance, although that would likely be very contentious and could split the network.
But what can't they do? Can they steal funds from my wallet?
No, this is critical. Even with 51% or even 99% of the hash power, they cannot create transactions to spend Bitcoin from an address they don't control the private key for.
Why not?
Because every transaction still needs a valid digital signature created by the correct private key. The consensus rules enforced by all the other nodes on the network require this. An attacker controlling the mining power can't magically forge someone else's private key signature.
So my funds are safe as long as my private key is safe.
Exactly. If a 51% attacker tried to include a transaction spending your Bitcoin without your valid signature, the rest of the network's nodes would immediately identify it as invalid according to the protocol rules and reject the block containing it. Tampering with amounts or recipients without the private key makes the ledger illegitimate.
That's a crucial reassurance for anyone worried about fundamental theft via network takeover. The cryptography holds.
The cryptography of the public-private key system holds. The attack targets the ordering and confirmation of recent transactions, not the underlying ownership secured by keys. And, it's worth adding, successfully mounting and maintaining a 51% attack on a large established network like Bitcoin is incredibly expensive and difficult, likely costing billions in hardware and ongoing energy costs.
Making it perhaps economically irrational for most actors.
Arguably so, though not impossible, especially for state-level actors perhaps. But the defense relies on both the cryptography and the economic disincentives. And again, it underscores the importance of using robust, well-tested cryptographic algorithms throughout the entire protocol. Weak crypto anywhere could create vulnerabilities.
This has been incredibly clarifying. So to kind of wrap up for everyone listening, especially those feeling hesitant, blockchain technology at its core isn't just some, unregulated Wild West.
Not the foundational level, no.
It's built on really sophisticated layers of cryptography hashing, Merkle trees, public-private keys, combined with clever economic incentives like proof of work. These work together to create systems that aim for security and verifiability without needing those traditional trusted middlemen.
Exactly. These concepts aren't just buzzwords. They are the actual mechanisms designed to provide the integrity and security of the network itself.
So coming back to those initial concerns about scams and regulation, while those are absolutely valid issues in the broader crypto space, in the applications and services built on top, understanding this underlying tech reveals that the foundation itself has these built-in security designs.
That's a great way to put it. The presence of scams doesn't necessarily negate the security properties of the underlying protocol, though it certainly impacts user trust and necessitates caution.
Right. Which leads to maybe a final thought for you to ponder. Given these strong cryptographic foundations we've discussed, where should the focus be to really build that investor confidence? Perhaps it's less about questioning the core tech and more about effectively addressing the challenges at the application layer, the regulation, the user protection, combating the fraud that happens using the technology, rather than within the technology itself.
That's a very pertinent question. How do we build secure and trustworthy applications and regulatory frameworks around this fundamentally secure base layer? It's definitely something the industry and regulators are grappling with.
Definitely food for thought. Thank you for that deep dive. That was incredibly insightful.
My pleasure.
Yeah.
Hopefully it provided some clarity.
We certainly hope so. Thanks for joining us on the deep dive. We encourage you to keep exploring, keep asking questions. Until next time.